So a Friday rally snapped a three-day losing streak. The sensex and the nifty ended the week in the green. IT bigwigs delivered with Q3 earnings. But what about the others? Big numbers lined up this weekend and the budget is just around the corner. What should you make of all the noise surrounding capital gains tax? And all that glitters is indeed gold. We analyze all of this and more in Editors Roundtable. Thanks so much for tuning in. I have all the editors here with me. Folks, it was a tricky week, right? I mean, we tested the 100 DMA, we tested the December lows. Thankfully, we held on to it, but by and large, the market texture has sort of weakened a bit.
I just have to say that this is just week 2 of 2023, right? And it already feels like, we feel jaded. I mean, at least I feel jaded, right?
and just 10 days and there is 10,000 crores of selling by the FI. That's a big number for the start of the year. To see 10,000 crores of selling from the FI. That's a big number. So I think at least they've started the year on a bad note for India. Whatever would be the reasons, they're moving to China or some other countries, but at least they've sold very aggressively in the Indian markets in the first 10 days.
You know, in cricketing parlance, I would say that the bowlers are the bears. You know, they're bowling yorker to yorker. Unfortunately, when we're going to around 17,750, it seems they're mistiming that yorker. And the bulls are smashing it out of the park. How many times have we gone?
So it's the Kohli that's coming in at 17,750.
At 750 and smashing it because, you know, not getting the yorker right, and that's why it's resulting in a full toss. I don't know, in the last, 20 days, we must have gone there at least 4 or 5 times.
This week, Nigel, we started this week at 18,000, we ended this week at 18,000.
Yeah.
But in that, every day virtually would have seen a 200, 300 points of rally on the Nifty. So that's the kind of volatility which has been there for the market.
Between that, few heart attacks, right? I mean, up and down. And, you know, so what you said, right, Nimesh, which is where is flow going? And I think the data shows that flows are actually heading out to some of the big underperforming markets of 2022. I put this out earlier, and you know, so 2 tables will come up on your screen. One is returns year to date, and the second is flows year to date. Returns compared to other markets in the region, and flows also compared to the same markets around the region. And I think it's very clear. So the returns are in dollar terms. India is up 1% dollar terms year to date. And look at the other markets, they are up much more. The graphic on your screen is flows. India has seen $1.4 billion of outflows, and other markets have seen, you know, from $500 million all the way to $2.5 billion. So the delta, the difference between what India has done in terms of returns this year and flows this year, when I say this year, it's 2 weeks, right? I mean, so, but it's year to date. So numbers are what they are, and it's very stark. So I think, as all of us were saying, that there is a little bit of reallocation, tactical, short-term, whatever it is, but it is happening. It has happened so far. The question is, will it continue to happen? And I think that is something we'll only be wiser about in hindsight. If the feedback that one gets talking to people who invest here, just here and around the world, as well as that perhaps this has got a little bit more to go before you know, you kind of normalize things a little bit. Quickly, levels really. I mean, I think that number around 18,000, the precise number is 17,780, 17,774 or so. That is a December low. It got broken once briefly intraday. We've come back above it. But I think that 17,800, just that's a round number to watch out for. And it's crucial that the Nifty kind of holds on to that. Otherwise, I mean, you're looking at the next big support is, you know, a retracement from the June lows of 15,183 to the all-time high. And that number is at about 17,500. So if this goes, you know, technically a 300-point downside kind of starts to open up. On the Bank Nifty, again, I mean, the numbers to focus on is the Bank Nifty never broke the December low, so that kind of becomes a support. For both the Nifty and the Bank Nifty, the 20-day moving averages, respectively, are, I think, the not trend changer, but I think it'll add more confidence to the bulls. It's not very far away for both. 1 or 2 more days, positive days, like what we had on Friday, can result in that. Next week, in terms of Qs, I mean, you've got plenty of earnings. So we really get into the thick of the earnings season, starting with, of course, today on Friday with Wipro and over the weekend, and then, of course, next week as well. And, of course, I mean, you know, global Qs, always important to track. 2 weeks away from the budget. I also looked at returns 2 weeks before the budget, and there is no clear trend. We'll talk more about that when we come back next week. So I think we got our hands full, especially with earnings and what's happening in the market itself. Nimesh, what are you picking up?
So, you know, Prashant, you spoke about the big 10,000 crore of selling from the FIs, but the big chatter in the dealing rooms was that a leading hedge fund was unwinding the India positions. Whether it's already done with, whether it's done 70%, only time will tell. But the feedback is they've sold most of the large cap stocks in the last last 10 days of January. So that's the overall feedback as far as who's been selling in the Indian markets. Looks like some of the large cap names are a little oversold, so that can be a bit of a support to the bulls. But I guess 17,800 is what we need to watch out for this week. Every day the bulls have defended 17,800 on the downside. Whether that will be the case next week, I guess some earnings can be a bit of a support to the bulls in that levels. I guess, for the next few days, few weeks, the earnings and the pre-budget expectations will be the big, talking point, and that will dominate the mind space for the investors as well. But I guess, even on the when we did the first series, the start of the year, I had said about some large blocks which are pending. The Kotak block didn't happen, but even this week you saw 2 large blocks in Paytm, despite the fact that there is further sell-off expected. So still then there was a bit of demand there, and we saw yesterday Shriram finance block got done, despite the fact that there is Piramal who's holding back, and even they can sell further. So despite that, there has been large blocks happening. So that's something to take away with. But the fact is there's a large sell-off from the FIs, and looks like one of the leading hedge fund was unwinding India positions. Only time will tell whether they're done with, and that can be a bit of a support if the bulls wants to take that part, and the fact that some large caps are a little oversold.
All right, Ramesh, thanks very much for that. We are going to focus on stuff you can touch and feel. Steel, gold, that's the focus today. Sonia is going to get to gold, but before that, Nigel, you're looking at steel, right?
Well, yeah, that's right. You guys are talking about the markets being volatile. I'll tell you what's been doing well, the metal index. So let's go across to the big wall and tell you more about that. So the metal index, in the last couple of months or so, the Nifty is more or less unmoved, but the metal index is up close to around 15%. Big outperformance out there. The China unlock is playing out, and there's a double bazooka that's playing out there. One is the Chinese economy is unlocking, so obviously a more amount of steel, more amount of metal is used. And the second factor is the domestic steel market was plagued because there was an export duty that was levied. That got pulled off in November itself. So good couple of tailwinds did come in for the industry. Let's run you through 5 big points that have been helping the steel industry in particular. The Chinese push. Well, there were 2 factors out there that was ailing the Chinese market. One was the property market. The second factor was there was no mobilization. People were stuck at home. Now, both of them are being addressed. So the Chinese government and the Chinese authorities are focusing on this. So good news out there. Second factor is the Chinese steel prices. Remember the HRC prices? Well, they corrected from around $860 at the start of 2022 all the way to around $500 odd. But with this unlock theme playing out, well, the pricing is currently at around $620, $630 per ton. So that's giving you a case that domestic prices will get some kind of support. Moving to the domestic prices itself. In India, well, the steel prices were at a premium in comparison to Chinese steel prices. That is, if you import steel from China, well, it was coming at a cheaper rate. Well, that's quickly turned around because from an 8,000 rupee premium, the Indian steel makers, they went ahead and they cut prices, while the Chinese players, they increased prices. Suddenly, the entire ratio has flipped around, and now you have the Chinese steel, if you import it, it's coming at a premium in comparison to domestic steel prices. A couple of brokerages like JP Morgan as well as BofA ML, they are expecting price increases of 2,000 to 3,000 in the next few months. Next up, iron ore prices. They've been on a tear, up close to around 50% from the lows that we recently saw. Remember, if iron ore prices move up, it gives a bit of a base for steel companies as well, and it's advantage India because India gets most of the fairest guys, they get most of their iron ore from domestic sources. Domestic iron ore is at a discount in comparison to imported iron ore that comes in there. And also keep in mind that if iron ore prices move up, then steel prices, they get a base, and in that context, India is relatively better placed. Finally, demand. Demand's been good. That price increase that's been taken at the start of January, it's been lapped up by consumers, so good news out there. Restocking is taking place. First, the consumers were saying, no, let's not buy, steel prices will fall. Now they're loading up yet again, and also in the coming quarter, you'll have export volumes that will pick up. Finally, steel and metals is not really about valuations, but we need to focus on that. It's more about momentum investing, and that's why we've seen these stocks run up. But more or less on a price to book value, it's pretty much in line with what they've been trading at. So that's about the metal and the ferrous space. But guys, Sonia, everyone doesn't track steel, right? People want to look at gold. Suddenly that's making a comeback. Tell us more about that. You've been tracking that space. And in fact, history suggests that gold's been a decent performer as well.
I hope you guys have bought some gold for yourselves, for your wives.
My little girl at home. 2.5%.
Whenever they tell you to buy gold, you go ahead and do it.
Absolutely.
There's a big degree of outperformance over there. So I'm going to talk a little bit about that. So, as they say, all that glitters is gold indeed. And this week, the big headline really was MCX gold hitting an all-time high. It hit a high of 56,000 rupees. Now that's a gain of 17.5% in the last 1 year alone. In fact, international prices hit $1,900 an ounce as well. That's a gain of almost 16% from the September lows. That's on international gold prices that will come up for you in just a bit. Now the question we're asking today is, with an expectation of a single-digit return in equities this year, or maybe not even that, is it better to move to alternate asset classes like gold? Will there be a continued up move over there? Now, what I did is I tried to assess the returns of gold compared to the Sensex for 1, 5, 10 and 15 years. And I noticed that for a majority part of the last 15 years, gold has seen a significant outperformance. Look at that, in the last 1 year, 13.9% up move in gold, while Sensex barely 4.5%. In 10 years, is the only one where gold has not outperformed. In 5 years, 13.5 and 12.5. And look at 15 years. If 15 years back you had bought gold, your compounded growth rate would have been almost 12% compared to just 7.6% for the Sensex. Now, of course, we do know why gold is rallying. A couple of key factors here. There's expectations of a mild global recession. There's a further weakening of the dollar. There's geopolitical flare-ups. So, there's an energy crisis in Europe, because of which perhaps people are moving their investments to safe haven like gold. In China, there's a reopening trade, so perhaps consumption of gold would go up there, and hence gold prices are looking good. But the question we're asking now is, does gold do well in a recession? And yes, it does. In 5 out of the last 7 recessions, gold has actually given positive returns. So we pulled out the data for you. Just look at that. Way back from December of 1973, gold gave you a 66% return in that recession compared to the Dow, which was down about 10%, and so on and so forth. Just take a look at 2001, gold gave you a 4% return, while the Dow was down about 8.2%. And finally, in March of 2020 to April 2022, gold gave you a 20% return. Of course, the Dow also had a commensurate increase over there. So that's the big takeaway, right? Gold did well in 5 out of the last 7 recessions. Just quickly on to what brokerages are forecasting. JP Morgan has said that oil and gold will drive the commodity returns in 2023, and they forecasted gold prices at $1,860 an ounce. It's already surpassed that level. But there is one risk. The downside risk is if there is a soft landing scenario. So I want to, in fact, toss this question to our guest, Ajay Srivastava, who's joining in of Dimensions Consulting. Ajay, this is something that is right down your alley. I think for the last maybe 3 or 4 months, you've been saying that equities is not the place to be. There are other asset classes, alternate asset classes that you should look at. Does gold top your list?
Of course it does. You already gave it all the statistics possible. Your mother told you, your grandmother told you, and they were very wise investors at this point of time. And it's brilliant that you put up this analysis, because it tells people that there is more to investment than the stock market. There's more to investment than the headlines. Simple, straightforward investment strategy, gold. And the reason gold is good is 2 things are happening. Supply doesn't go up dramatically, but all the central banks, whether it's India, whether it's China, whether it's Europe now, they all are stocking up gold. So, not only there is a consumer demand, there is a huge demand from central banks to shore up the gold reserve. And quite obviously, as arithmetic goes, when the reserves go up, the proportion of gold they need to maintain has to also go up, and therefore they need to buy gold. So gold will remain an absolute gold standard for investment for the 3 reasons. Central banks want it. It's most liquid of the all. And when the market hits the real bad patch, it's gold which counts in the end. So I would certainly say gold will remain, should remain a decent part of, I'm not saying put everything in gold, but should remain a decent part of a portfolio. And I think I heard you saying jewelry. Don't even count that as an investment. Man, that's an expense. Book it.
Sovereign gold bonds. Yeah, I know what you're getting to.
Ajay, so exactly that point. And just to complete that loop on gold, what is the best way to own it? I mean, gold, in what form? Sovereign bonds or something else?
ETF.
I think I would say sovereign gold bonds is good, but I would still prefer physical gold to hold with us, because government is government at the end of the day. Physical gold I would like to keep, and some of the coins which are coming up in the Hong Kong coin and the other stuff is a premium to the market. You can't get them if you want a large quantity. So I would say bars, physical gold in bars and coins would be the right way to do it. Put part of it in the 2.5%, because that's subject to government can do what it wants, the rate what it wants. So physical gold over paper gold any day.
Okay, with that, let's take a short commercial break on Editors Roundtable. We'll be back in a bit. welcome back to Editors Roundtable. As earnings season kicks off, what can investors expect from Q3 earnings? Nimesh, are you looking at more EPS downgrades, and what light can you shed on this?
So, I've looked at the earnings, what to expect in Q3. We've already seen some IT companies reporting, and the broad line is that the top line is good, but there is a hit on the margin. So, looks like that's going to be the big theme in the Q3 earnings across the board. So, the big picture is expect a muted earnings, so no big surprises there. Post Q3 earnings, you can expect a 4 to 6% EPS cut for FY23. That's the consensus across most of the brokerages. Now, where the earnings cut will come in, it will come in energy, materials, and consumer discretionary. Whereas you will see a positive surprise in the financials, but to some extent, that's in the price. It's going to be margin pressure across the sector. That's the overall feedback from most of the brokerages. Now, I've looked at the sectoral trends as well, to what to expect in various sectors. I'll start with autos first. In autos, expect a bit of a gross margin improvement because of the cooling commodity prices. So that's something for autos. For capital goods, the order book will be most important to track in Q3. For cement, that's going to be interesting because for cement, the expectation is there is going to be some improvement quarter on quarter in terms of EBITDA per ton. So that's something to watch out for as far as cement is concerned. For discretionary and retail, the commentary on demand slowdown will be very important to track in terms of earnings. For financials, that's going to be very important. You're going to see a very strong credit growth plus the NIM expansion as well. So that's going to be a double benefit for the financial sector. For pharma, a decent sort of domestic demand. And for telecom, a very small ARPU growth is what most of the brokerages are expecting. I'm also looking at some of the individual stocks. There was a Citi note on expectations from Q3, and they've put out some stocks which will be positive and negative surprises. In terms of positive surprises in Q3, Ambuja Cement, SBI Life, Ashok Leyland, L&T and Cipla. These are the stocks which can surprise positively in terms of earnings. And in terms of negative surprises, Tata Steel, TVS Motors, Page Industries, Adani Port, United Spirits. These are the few stocks where Citi expects a negative surprise in the quarterly earnings. So the net, the big picture is expect a 3 to 4% or 4 to 6% EPS cut in FY23 post Q3 earnings.
Okay, all right.
Okay, all right. Thanks for that, Nimesh. Well, Ajay, this market has been moving higher, and we have been the big outperformer because we are going to get the best earnings growth. That suddenly seems to be in a bit of doubt, right? Because earlier we were talking about mid-teens growth for 2 years, easy peasy. Suddenly that's going to be in doubt, right? What's your take on that?
Well, you are simple. If you have inflation at 20% again, you'll grow at 22%. It's as simple as that. So I think people who mistook inflationary growth, which has happened in the bank portfolio as well, to be the real growth, need to do the calculation at the end of the day that how much of it has come from the inflation and how much it has come from the genuine industrial growth. You can't have a thesis that India will grow at 6% and this 6 months will grow at 4.5%, but banks will grow at 18%. Banks can grow at 18% only, and margin can grow 18% if inflation is above 10%. And if the target of inflation is 5%, then there is no way the economy and the banking system, for instance, and the people under the bank can grow by more than 10%. It's arithmetical. It's nothing exotic about it. Yes, there will be outliers. There will be outlier companies, and that's the beauty of every market, and you get paid for it, is to identify those outliers who will restructure the industry, who will score over the people, etc. The problem here is not the margin. The problem here is not the expectation. The problem is we're starting off a base of over-enthusiastic mass of retail investors who are pumping in money in the market. Now, their hope is somebody's going to buy on a P expansion mode because everybody knows, you can't go much beyond the economy, maybe double the economy. If you double the economy, it's 12% growth. But your Ps are running at 30s and 40s and 50s and thereabouts. Now, how does that portfolio maker grow? That's the challenge here. So your challenge in India is large bunch of retail investors hoping against hope that their returns will exceed the fixed income, which it is not happening. Now, when will they realize it? We don't know. But right now, the mood is very simple. Pick your companies very carefully. Are you feeling lucky on the day you pick your company? Please focus on them. Don't look at astrology chart. I didn't mean lucky that way. Analyze them deep to see that these companies can grow well in spite of a low growth economy trajectory. And, and we have to have the honesty to look at the fact that 80 crore Indians as a population need food grains to survive. So Indian economy is really worth about 20-30 crore people. Headlines saying Mercedes-Benz sells highest cars ever in the history does not make the economy. So therefore, prudent selection, I think, is the answer here. And, you got to be realistic as to what you're doing. And if you bought at high Ps, Well, you can average and keep averaging.
Okay, I thought you were going to end on an optimistic note. That's a rather somber note that you're ending the discussion on. It's the weekend. Come on, you can lighten up a little bit, Ajay.
No, I can lie to you by telling you the beautiful thing is that please, and I've been saying this, spend your money. That's more important. Spend it on your parents, spend it on yourself, spend it on your wife, be in the good books of everybody around. Because in this economy, at inflation at 7-8%, you're really not saving anything. You're worthwhile buying stuff and enjoying it. And that's been a mantra saying, forget all this investment. It gives you grief at the end of the day, right? You put your money, save, put it there, and don't make a return. Can you imagine?
Right.
It's bad.
Ajay, thank you for that wisdom.
You're welcome.
Much needed now, especially post-COVID, right? That's how people have changed. Just go out there and have fun. Thanks a lot for joining in. But now we're going to start talking about the budget. And then once again, all the chatter will be on capital gains tax. So Prashant has put some data together. Prashant, is it all noise?
I mean, on some aspects it is. And let me tell you why. So this is not a, budget 2023, what to watch out for. Rather, this piece is about budget 2023, what not to watch out for. And that's basically the capital gains taxation regime. Already you're starting to hear this like clockwork. Every budget, I think the one thing which happens is the rumor mill starts working overtime. And people start talking about how there will be changes to this tax rate, that tax rate, especially on the capital gains tax side. Now, what we're saying is it's best to just ignore all of this because no one knows. And I'll tell you why. Where did this kind of rumor mongering in that sense start from, right? It started from an interview that the former Revenue Secretary gave CNBC-TV18 on in November, 29th of November. He spoke with my colleague Shireen Ban, and he spoke about this subject. And what did he say? He said, we had done some preparation. Now it will depend on policymakers. Some preparation on, of course, reviewing the capital gains tax regime. He said, one thing is for sure that our capital gains tax regime is very complicated and it needs simplification. We have buckets, we have, different time periods, different taxation rates, and all of this needs cleaning up. And he ended by saying the time to do it maybe was yesterday. We will find out on the 1st of February. That interview, I think, sparked off this debate. This is the Revenue Secretary at that point saying this, that maybe we will hear something this time around. But he also made it clear it's up to the policymakers. He's not involved in the policy, in the budget making, so it's up to them, and we can find out. Now, I'm not saying that nothing is going to happen. Something can happen, most definitely. All I'm saying is, this rumor comes back every time. People talk about it. Sometimes markets are gripped by fear. There is actual selling which takes place, and we only come back and find out on the 1st of Feb if something has happened or not. Let me just quickly put out the lay of the land in terms of why this capital gains tax regime is so complicated, right? This is, all these columns, this is the instrument. So equities, listed stocks, international equity funds, unlisted equity. This is the short-term capital gains tax. So, for example, listed equity short-term is 15%. The slab rate, of course, is whatever income tax slab you fall under. This is the long-term capital gains tax, different, of course. And then this is the holding period, which makes you eligible for the availment of the long-term capital gains tax benefit, right? So again, this is different. And this is what Mr. Bajaj was talking about with respect to the different slabs and all of the complication, really. And I'm not even mentioning all. I'm just mentioning, I think, about 8 or 9 instruments. Listed bonds, real estate, gold, ETF, etc. I think are the others where you can see, I mean, there are different changes. And it really needs a tax expert if you want to kind of simplify all of this, even to file your return in some cases. I spoke to a range of Big Four tax experts, and this is the feedback that I got, right? And I'm kind of simplifying this here. Many said that this is the last full budget before the election in 2024. So it's possible that the government may want to do something which is meaningful in terms of tax rationalization. It's not an unreasonable kind of expectation. Most agree that rationalization of the holding period threshold will be the first step. Not the tax rate itself, not changes to the tax rate higher or lower, but the rationalization of the holding period. Like, for example, in the US, across asset classes, it does not matter. The holding period to be able to eligible for long-term capital gains tax is 1 year. So it's simple, it's flat. Could we see something like that? If something were to happen, tax experts agree that that is the place to start. Whether tax rates themselves see changes, I think this is something on which opinion remains very, very divided. As I said, the purpose of this piece is not to say that nothing is going to happen. Something may well happen, but I think history shows us over and over again that over-obsessing on this is, I think, pretty futile. We will find out on the 1st of February. Back to you guys.
Okay, well, thanks a lot for that. So that's your prep for the day, for the week. But with that, it's enough of work. Now time to enjoy your weekend. Thanks a lot, folks, for joining us on Editors Roundtable. Have a great one. Do stay tuned in to CNBC TV 18 for more news and updates.